Hello, everyone, and welcome back to the Velocity channel where we are your bridge to financial freedom. Listen, today we have something interesting, very interesting for you. All right. We're going to show you how consolidation is one of the keys that you could use to get out of debt and into wealth more simple than you've ever had thought of in your life. So before we do that, though, we wanted you to go ahead and like, share, and subscribe so that everyone all around the world can know how powerful the Velocity banking method is. Because really, you have not seen anything yet. Now, what we want to do is we want to show you how many cards that we have, because that's going to be very important, okay? I know there are people that have multiple cards, but the recommendation on the credit cards is at least 3 to 5 credit cards. Why is that? So that you don't have too little and too much, right? Remember, lenders look at that, credit card companies, they look at that because they're wanting to know, man, is this person going to be responsible with what we're giving them? Because at the end of the day, they got to get paid. Now, right here, we have 5, okay? That's the maximum recommended, 5 credit cards. On these credit cards, though, they have $1,000 balances, right? And these $1,000 balances are at different interest rates. $1,000 at 30%, that equals $300 in interest per year. $1,000 at 10%, that equals $100 per year. $1,000 at 20%, that equals $200 in interest per year. And of course, last but not least, $1,000 at 25%, well, that equals $250 in interest per year. Now, why did I say that? Well, because the credit card companies, boy, they get paid daily. Okay, they charge an average daily interest rate. And so how you figure that out is you go ahead and you divide the number in interest dollars, right, by 360. That's a banking calendar, all right? The regular calendar is what? 365, 366. The banking calendar is 360. So 300 in this example divided by 360, and that is the daily average interest that you are getting charged on that running balance. Now, remember, consolidation is the key. But when I say consolidation, I do not mean consolidation loans, all right? That's how you give your money away and become broker and broker and broker. What we want to do is we want to consolidate the lines anywhere we can. Now, in this example, let's say we got that 5th credit card, all right? It's kind of like the 5th element, all right? You ever heard of the 5th element? That's the element that's inside the city, right? That's going to take the city down. I mean, it's impenetrable. The walls were impenetrable, but they have a 5th element, right? And that's what's going to take the city out. So this is what we're going to do. We're going to take this debt out by leveraging our 5th credit card, our 5th line, our 5th element, so to speak. And even though this 5th element has at 20%, guess what? All of these, we can do a what? What is that called? A balance transfer. 1,000, 1,000, 1,000, and 1,000. Now, CJ, why did you do that? Well, all of these are paid off now. That's why I did it. And now we can use this credit card as our Velocity banking tool. We can use it as our new checking account. The reason why you would want to do this and not split up your payments is because let's look over here. We have about $125 each month as a minimum payment. But what you may not know is that $125 each month altogether here is split up. And which side do you think gets the most? You or the bank? We see that about $70 in interest goes towards the bank and $55 goes towards the principal. Now remember, you split up these charges. So that's $55 divided by 4, which is what? Around 12 something, right? Listen. What is that? 13? Closer to 13? Okay, 13 times 4? 13. And that's going towards your principal. Do you see why many times you can never pay that off? You can never pay the cards off because it's split up. That's why we tell you to consolidate your lines, because you're getting done that way all over the place. Versus, hey, we're going to go ahead and use this. Okay, we're going to put all of these, we're going to do a balance transfer up here to the $5,000 card, right? And yes, we owe at the 20%, but we're going to use our income, aren't we? We're going to use our income in a way that will dramatically lower this amount. Now, let's say you go ahead and get paid $2,000 each month, all right? And you got $1,000 in expenses. Remember, folks, please don't get caught up in the numbers, okay? We're just doing that for easy math. You can place your own numbers right there. So $2,000 in income, $1,000 in expenses. You're going to use this as your new checking account. So you'll shift that $2,000 into the credit card. How much do you owe now? That's right, just $3,000. Because $5,000 minus $2,000 is $3,000. Now, when are you going to pay that card off? Let's go ahead and see if we can put this balance here. And we divide it by 1,000. We cross out those zeros. And it's telling us that we can actually pay this off without starving, without going on the red beans and rice diet, okay, in 5 months. Without even trying, right? Without a second and a third and a fourth job, man. You don't have to do all that. You just got to use the card the correct way. Does that make sense? And so if we do the velocity banking method with this credit card, not only have we instantly paid off all 4 cards, right? We transferred that balance up to a card that we can use now, not only to pay the expenses, but other things. Maybe you want to get rid of some loan and you need a place where you can grab that principal, right? How are you going to pay that principal? Well, you can grab some money out of that credit card and put it towards that principal, because now you know how to pay the card off. Look at that. We're talking about $5,000, okay, gone in about 5 months with a $2,000 income. It's very, very doable. But, well, CJ, my income's $5,000. Then can you leverage more? Perhaps your card needs to look like this. And what can you do with that leverage? Because you're supposed to be using your credit cards for what? Assets or consuming? Assets. It's supposed to be making you money. Man, I forgot the brother's name, but he showed me how to do, he's a YouTuber as well. He showed me how to buy watches with credit cards. Man, we need to collaborate. You could do that. Look, with that. Man, you got to look him up. I don't know his name right off the top of my head. Man, if you know his name, go ahead and comment his name here. I got to give that brother a shout out. Hey, Hakeem, shout out to you, man. Shout out to you. You know? But look, there's nothing up my sleeve. Yes, the percentages are there, but there's no reason that you should not be out of debt. Now, if you're having trouble with that, please contact us. That's why we are here. All right. Remember what the banks are doing to you. Let's go ahead and get over here. The minimum monthly payment, sometimes they're going to make sure that they get more than you do. Many do. Many do. And there are some that don't, of course. So that's not a blanket statement, but many are like, you know what? These people don't know any better. So we're just going to go ahead and give them $125 minimum monthly payment, and we're going to split it up like this, where we're getting more, they're getting less. But is that what you want? Or do you want to consolidate the line and turn that $5,000 into $15,000? Because what happens when you're responsible, when you're showing responsibility in your credit cards and your credit lines? What happens? Do credit limit increases still happen? You bet they do. And they can happen to you. All right? God bless you all. Listen, if you have any questions, don't hesitate to get back with us. We'll see you and have another video for you very soon.